It was another sell-off day on Wall Street. We've been saying that quite a bit in 2022. The good news is today was only about a 0.5% down for the S&P 500. However, there were some players that managed to close in the green today, including the energy players. And that was somewhat surprising given the fact that oil itself was actually down here today. So we'll talk about that. We'll also get into some evaluation of the small cap Russell 2000 and show you some outperformance there. We'll talk about some of the macro factors that have led to interest rates rising to over 2% on the 10-year Treasury yield. And then we'll get into a trade application example that's near and dear to my heart as a farm-related play of a stock that is trending nicely and benefiting from some of the agricultural inflation that we've been seeing out there lately. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 10th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below and make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. In addition to that, remember that at the bottom of those emails, you'll find the stocks that are giving you overbought and oversold cluster signals within the S&P 500. When I did this video on Tuesday, I was somewhat amazed that nearly 1/5 of the entire S&P 500 was in an oversold cluster stance. So kind of interesting to see that, and very few, if any, overbought clusters. So kind of gives you a sense of the sign of the times here with the sell-off we've been dealing with lately. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And as you can see from our heat map, we probably have a bit more red than green here today. It wasn't an overwhelming bloodbath today like we've seen countless times in 2022, as the market itself was only down about 0.5%. But you can get the general sense here, at least my eyes seem to suggest that there were more stocks down today than up. I see a lot more red out there than green. And of course, what stands out the most is the biggest squares and rectangles, especially up here in the upper left, as we had yet another tough day for technology-related firms. Microsoft is down 1%, Apple was down 2.7%, Alphabet was down 0.74%. The good news in that regard, speaking of the largest companies out there, is one that obviously stands out here is Amazon. If you haven't heard the news yet, they actually announced a 20-for-1 stock split, kind of following in the footsteps of Google. We actually had a good chat about that in my question and answer session here today. Strangely enough, Amazon's 20-for-1 split will actually take effect in June, and Alphabet's will take effect in July. So even though Alphabet announced theirs a long time ago, Amazon's will actually get theirs done sooner, at least as long as everything goes as planned with that. So that apparently caused some excitement around Amazon shares here today, and that was the rare mega cap stock that finished well in the green here today. It was up over 5% when it was all said and done. But as you can see, most of the other major players out there did finish in the red. In terms of other areas that managed to garner some strength, you'll notice that once again, energy was one of the go-to areas. Now remember, yesterday, oil sold off and energy stocks largely sold off. There were a couple of exceptions to that. I know Chevron was able to buck the trend as an example. But yesterday it made sense that energy was down because oil was down. Today we actually had oil down again, but the oil stocks refused to go lower. And that is a sign of strength right there, or at least that is the inferred mindset that comes with that. They just refuse to be sold off, and anybody who owns them refuses to sell them at this price. And anybody who has attempted to short the oil companies in the last, let's call it 2 or 3 months, probably has a big problem on their hands right now, and that could very well be fueling future upside opportunities for those stocks, because remember, if you've sold short those securities, you eventually have to flatten your position by buying the stock. And so I have a feeling there's a lot of short sellers in the oil patch right now that are growing more and more concerned by the day as a result of the dramatic move that we've seen out of these. We talked about that a little bit on Tuesday's video with Exxon and Chevron moving some of the fastest I've ever seen those two dividend aristocrats move in just the last month or two. So it's been very interesting and educational to watch what's happened with some of those commodities plays. You'll also see that a handful of retailers managed to close in the green. So Walmart, Costco, Kroger all doing pretty well. Kroger is one of our top-down trend trading holdings, so we're happy to see that one making a move higher there. But I did want to point out that in general, consumer staples did poorly here today. Remember, Walmart, Costco, and Kroger are all technically part of the consumer staples group. They're not discretionary, they're staple-oriented. But the products that are supplied on the shelves at Walmart and others come from folks like Coca-Cola and Pepsi and Procter & Gamble and Colgate, which, by the way, I just tweeted a moment ago. Colgate just raised their dividend for the 60th consecutive year. Yes, I said 60, not 16. That is quite a dramatic and impressive streak that Colgate has, one of the rare dividend kings out there alongside Procter & Gamble. So regardless of economic situations, whether we're in warlike conditions, whether we're inflationary-like conditions, whether we're having some sort of a financial catastrophe with a domino effect, with the Lehman Brother effect, it doesn't really matter what you threw at Colgate in the last 60 years. All they've done is just kept on raising shareholder pay for that dividend stream. So pretty impressive there. But I did want to point out that in general, staples were down today, and in some cases down pretty significantly. In fact, one of our sold puts is being threatened right now. In fact, a couple of them, Clorox and also Kimberly-Clark. Kimberly-Clark, we sold, I believe, the 120 strike, and it closed today at 119.79. So both of those, Kimberly and Clorox, you're going to want to keep an eye on and ask yourself, do you really want to take ownership of them if you have an options expiration date coming up? Now, speaking of that, I'll actually be out of the office next Wednesday and Thursday, so I won't be doing this video next week, and so I won't get a chance to remind you the day or the night before options expiration, which will be that Friday, where I'll also be out of the office, that you'll want to make sure you're kind of babysitting your March positions, right? We're coming up on that pretty quickly here, and things have been so volatile across so many different markets that we kind of lose sight of the fact that, oh yeah, we've got another options expiration about to hit. So make sure you're taking a good look at your portfolio and make sure you're sitting where you want to be with those positions. And I might end up closing down a bunch of positions before I leave and head out of town, because I won't have my computer with me necessarily, and therefore I don't want to necessarily be closing them out last minute somewhere in a hotel room. And so I might do a little bit of tidying up before I leave. And if you're a premium member, of course, keep your eye on the Telegram app, so that way you can see the screenshots of whatever decisions I make there for the account. But anyway, I thought it was kind of interesting to see such a spillover in the vast majority of consumer staples. Remember, we had that conversation just to a degree on Tuesday, because that was the day we were getting all those announcements from Coca-Cola and McDonald's and Pepsi and Starbucks and all these companies that were saying we're pulling out of Russia, and we started to see a lot of selling that resulted in those decisions. And it makes sense. I mean, if you're gonna pull out of a major country and say we're just going to basically throw that money down the toilet, right? They're still paying employees and things like that in many cases, but they're just basically saying we're not open for business. And so naturally, that is not a good thing for profit-seeking shareholders. So while I don't necessarily like the fact that many of those companies are going down, because I happen to be a shareholder of many of them, as they are a lot of cases dividend growth companies, I certainly understand why the stock market is sending them down. And they're making a political statement, and hopefully that was a right decision longer term. But in the short term, they are going to have to feel the sting of squished profits compared to what they would have had otherwise. So it's been interesting to see things shaking out there between Russia and Ukraine, not just from the obvious areas like energy and commodities, but also now how that's affecting American corporations who are making the decision to pull out of that country and lose a lot of profits along the way. So keep your eye on that developing story, as well as other companies may very well come out and make those same announcements. We also had a little bit of strength in healthcare here today. So you'll notice that Johnson & Johnson, Pfizer, United Healthcare, Anthem, and Humana, and Centene, a number of these all finished here in the green. Now remember what I would mention to you in Tuesday's video when we talked about United Healthcare as the trade application example, that the health insurers were kind of interesting to me because they are a rare area that seems to have very little impact from the Russia-Ukraine situation. And so most of what they do is, service folks who are going to the hospital and things like that here in the United States, and that generally does not cross over all that much. Maybe they're going to get some inflationary pressures that kind of pinch their margins or what have you, but for the most part, they're pretty well removed from the Russia-Ukraine situation. And so I just get the sense that they are going to be able to get a little bit of a hall pass right now compared to a lot of these other companies where there are very unique things that are affecting their profitability at this moment in time. You did see that a lot of the financials were down today as well. In fact, I just got done tweeting something about one financial that happened to catch my eye. In case you're interested, I'll show you here real quick. Where was it? It was this one. BAP, which is Credit Corp, is a rare uptrending stock from the financial sector that's near a 52-week high, and that's kind of what that chart looks like. The reason I pointed that one out specifically is because most other financial charts do not look like this. They don't look anything remotely close to this. So sometimes if there's one or two stocks that's kind of breaking away from the pack, and what the other stocks in their sectors or industries are doing, it's worth paying attention to. Remember, we got that to a degree back in the wipeout of the coronavirus time period when Moderna kept on going up day after day, even though the market was cratering like 5 or 6% in some cases on a single day. And Moderna would just go up like another $1 or $2. And it was almost like a heads up in advance that you're about to watch Moderna rip for the next, year and a half. Obviously, here more recently it struggled, but you saw one of the most, explosive moves, especially from a market cap perspective, where Moderna actually ended up becoming a $100 billion company from a place where most people had never even heard of it before that. So it was kind of the stock market's way of saying that that's the kind of the poker tell. When one stock is doing something that all the rest of its sector is not, then there may be something behind that story. So keep BAP perhaps on your radar there as well. Let's go ahead and pop on over here to the normal 4 grid now. And I want to show you that after today's selling, we still do not have any posture change to make you aware of. And that should make sense, right? We've, just like I said on Tuesday, we had a clean sweep for strongly bearish postures. And at that time, all of these charts were trading under their 30-day moving averages, in fact, falling 30-day moving averages. And, with more selling here today, not a surprise that they stay with those postures. Now, one thing that I will point out, and I've been trying to make a point of this for the last several weeks, so this should not come as a surprise to any of you, but I will once again reiterate it because it keeps on happening, and the more it happens, the more likely there is a story behind that situation, and that is the Russell 2000 continues to impress. You wouldn't necessarily notice it if you're just looking at the chart all by itself, saying, well, who cares? Nothing much going on there. Russell 2000 was down 0.23% today. What's the big deal? Well, not that it's a huge deal yet, because again, I'll reiterate the same thing I said on Tuesday, which is right now we have to assume that trends are still to the downside. But if, and that's a big if, but if we do have some sort of a market reversal to the upside in coming months, do not be surprised if it's the Russell 2000 that becomes the leadership group. And that is something different than what we had experienced for much of the past year or so. In the past year, we've seen the large caps be more of the leadership group. And so this is somewhat new and provocative, perhaps, because we haven't been hearing a lot of other people talking about it. But we certainly have been telling you about it here in these videos. Notice that the Russell 2000 was today's best performer. Typically in the past, when the stock market was down, the Russell 2000 was down even more than the markets on average. But what we've been seeing recently is the opposite. When the stock market's down, Russell 2000 is down the least amount. Remember, usually that's the Dow Jones Industrial Averages role, because that's where you kind of hunker down in the blue chips. So it's saying something when the Russell 2000 is the one that refuses to go down violently. So they were the ones that led today's market. Yes, they were still down, but they were down the least amount, and that was similar to what we've been seeing in recent weeks as well. Not only that, but notice how the moving average looks different on the Russell 2000 compared to these other three charts. On the Russell 2000, that moving average is yellow. And it looks like the stock, or in this case the ETF, I should say, is trading basically spot on the moving average itself. Notice the moving averages for these other three charts. None of the other ones have another color except for red. They're all red. And not only that, but the candle, today's candle, is well below those moving averages. So it should be pretty obvious to all of you, even without the assistance of David and I, that there's something cooking there with the Russell 2000 comparatively, and it wouldn't take much for the Russell 2000 to start establishing a new trading range above its 30-day moving average. Right? We talked about it briefly over here, and we didn't know, was this going to be short-lived the way that it was over here, or was this going to be the start where the market is telling us something underneath the hood that maybe not a lot of people are picking up on? And I'm still open-minded enough to say that that is a possibility, right? With us battling right back to that moving average yesterday and then hanging right there again today on a day where there would have been an excuse to sell off the small caps, and they just didn't take that opportunity, this is becoming more resilient. Additionally, like I mentioned the last time around, remember these other charts clearly have kind of lower highs and lower lows, but the Russell 2000 was sold off earlier in the move, and one of their big lows was right here in January. You technically got just a touch lower than it on an intraday basis here on February 24th, but from a closing price basis, this was the lowest close. Right here is actually January 27th. All of the other closes since then have been higher. The other indices can't make that claim. Notice where we were on January 27th for the S&P 500. We're trading below that as we speak at this moment in time. January 27th over here on the Dow Jones Industrial Average would have been that candle. Same thing. We're trading lower than that level at this moment in time. And then with the NASDAQ Composite, January 27th would have been that candle, and same thing. We're actually trading below it on tonight's close, below those closes. Whereas with the Russell 2000, that was the lowest close, and we have not yet closed below that zone. So that should be telling you something, that there's more resilience in this chart than what we're seeing from the others. And so if there is some sort of an attempt at some bullishness as we head into the summer, let's keep our eye on the possibility of the Russell 2000 becoming a leadership group in that sort of a mindset. But unfortunately, right now, it's just a thought to put a pin in, because right now, as I mentioned before, the path of least resistance does continue to be to the downside. All of them continue to have strongly bearish postures, and all of them, except for the Russell 2000, have charts where their current price is below falling 30-day moving averages. And until we start spending more time above those moving averages, you've got to sell first and ask questions later type of a mindset. If you're a trader, right? If you're a long-term investor, that's a different story. But if you're a trader trying to follow these charts, then clearly we still have a lot of work to do. This is still a more bearish environment that we happen to be operating within. In terms of the absolute returns here today, S&P 500 was down 0.43% today. Dow Jones was down 0.34% today. And then the NASDAQ Composite was the worst performer of the day. It was down 0.95%. And I did see after hours a couple of big NASDAQ names like DocuSign and also that new EV company Rivian came out with earnings, and their stocks are plunging after hours. So that probably doesn't bode too well for the NASDAQ at this moment in time. Obviously, things can change before we get into tomorrow morning's open, but right now there's probably a little bit of continued selling pressure after hours on some of those high-tech oriented themes there. Let's go ahead and step away and take a look at the internet here briefly. I always like to get a chance to say thank you to those of you that help support these Market Outlook presentations. Remember, David and I do not get paid to do these videos, yet they take 3 hours out of our day. And so we always want to make sure that we have the mental justification, even if we don't get the monetary justification for doing these videos. And how we get that is by recognizing that hopefully you guys are getting value out of these videos. And the way that you tell us you're getting value out of these videos is to click like for us on Twitter. If you're not getting value out of these videos, don't click like for us. If you are getting value out of them, then the best way that we'll be able to bring these videos for you to you for free for the foreseeable future will be to let us know through those likes. And so generally what I do is, as long as we're up and over 100 likes since the last time I did the video, I'm willing to do another full-length video for you the next time I do the video. And so since we were at 102, again, we just barely got by. In fact, if I'm not mistaken, it matches to the exact what we had the last time I did the video. I think this is 2 straight videos of mine that landed on exactly 102. So if it's all 102 of you that did it both times, thank you. We appreciate you and your willingness to help support these videos, keep up the great effort on your end. So if you want me to do a full-length video when I'm with you next time on Tuesday, click like for me. If you'd prefer just the 15-minute quick hitter video where I don't do the trade application example and all the extra 12 grids and all that kind of stuff, then don't click like. And I'll let you guys decide collectively what side of 100 we land on for Tuesday. Also, while we're over here, just a reminder that we always teach excellent premium content. Remember, that's where we do get paid. So remember, we don't need to scratch the itch of doing these free videos on YouTube if all we want to do is teach. We're teaching all day as is. So earlier today, I taught a 3-hour class, which is my question and answer session. And then David taught his portfolio management with ETFs class. So make sure you're checking out those recordings. And then tomorrow morning, make sure you join David at 1 p.m. Eastern Time for his technical analysis class, which is always some excellent insight from a CMT who really knows his stuff around the chart. So make sure you're taking advantage of David's mind each Friday there. Earlier here today in my question and answer session, for those of you that might have missed it and are wondering if you should check out the recording or not, here are some of the topics we covered. We had a long discussion about buybacks and whether buybacks are useful, whether they can game the system. I showed some really intriguing examples, one from a company that had bought back about 1/3 of their company stock since 2005, and then I showed another example of a company that had bought back 75% of their stock since 2005, and it has been an absolute home run. So if you're intrigued with what those companies are, feel free to listen to that portion of the class at the 13-minute mark. At the 55-minute mark, we talked about international flavors and fragrances as a potential dividend growth investing candidate. At the 1 hour 37-minute mark, we talked about Google and Amazon and kind of had a high-level discussion about stock splits and whether they were good or bad or whether they were a non-event and some of the practical benefits of splits that sometimes some investors may overlook. We also got a question about how to find stocks that are losing momentum, like eBay and some others that I kind of mention occasionally in my factor-based swing trading class, and how do we think about 6 different groups to categorize stocks within. We also had a question at the 2 hour 26-minute mark about some good investing books that I could recommend to folks that perhaps I gained some value from over the years. I also got a question at the 2 hour 34-minute mark about Snap-on Tools as a potential dividend growth investment candidate. Got a question at the 2 hour 56-minute mark about the idea of selling puts on UNH as opposed to the Iron Condor that I showed you guys on Tuesday, and kind of some thoughts about how theta tends to work better in the nearer term months as opposed to the further back months. And then a question at the 3-hour and 9-minute mark about MGPI as a potential short candidate for the factor-based swing trading class. So if any of that intrigues you and you're a current premium member of Market Scholars, check out all of that excellent commentary there. Also, let's talk about our factor selector tool. Now this tool, as a reminder, I get updated on Tuesday after the close, but it gets posted Wednesday morning. So in other words, there have been 2 full trading days since these rankings have been made. Usually there's not a whole lot of difference in just 2 days, but I always like to be upfront with you guys on that point. But what we saw as of Tuesday's close is that dividend yield continues to lead from a factor perspective. This is actually the 7th straight week that dividend yield has been atop these rankings. On the downside, there is something new to report, somewhat new, I should say, because momentum fell back to the last place position. But keep in mind, back here, remember, momentum was actually dead last for 6 weeks in a row back here in January as well. So maybe not a complete surprise to see them back there. Remember, oftentimes when markets are choppy and there's folks that are running the VIX higher and people are trying to hunker down in safety types of assets, they run out of the momentum stocks. Remember, momentum stocks are effectively the ones that have run up the most, let's say, over the last year. And many of those charts, we've talked about those Cathie Wood types of charts before, right, that ran up tremendously after the coronavirus wipeout and then have been nosediving in the last several months since. If you just kind of understand that concept at a high level, you can probably understand why momentum as a category is really struggling right now as well. Let's go ahead and pop back on over here now to the paper money account, and let's do some more charting analysis starting with chart 5A. This will be our asset class 12 grid. Now, reminder on these particular 12 grid charts, the background color is only going to be one color as opposed to changing repeatedly like some of our others, because it would just be a little bit too much for your eye to fully interpret, I guess, if the charts are too small. So in this case, when you see the solid colors like you do, what it basically means is what is the current intermediate posture using the market forecast technical indicator. And so you can see on the bottom rung, we do have some green charts, and what that means is we have bullish intermediate postures using the market forecast. All of those pink charts that you see mean that we have bearish postures using the market forecast technical indicator. So let's maybe start down at the bottom rung, because that's been maybe a more interesting place to be hanging out lately, where investors have actually been able to make some money. As you look at those 4 bottom charts there, notice that all of them are in uptrends. In fact, they're the only ones on this grouping here. All of the other 8 charts above it have stocks, or ETFs, I should say, that are trading below their moving averages. So notice that on this bottom rung, all 4 of those charts have green current moving averages. One difference we do see is with oil. This is what I had referenced before, where it was somewhat surprising to see the strength in the oil stocks here today, because oil itself was actually down for the 2nd straight day. And because this has been such a violent rip higher initially and now a collapse lower, there's been enough movement from the recent highs where the market forecast is positioned in such a way where this is now perceived as weakly bearish. Now, before you get too carried away with that concept, I would encourage you to have a little bit of caution around that, because what it's basically showing you is that we got too far too fast on the upside. And now when we give back a big chunk of that, the indicator has to reflect that. Remember, if you wanted to, if you're a premium member and you have access to all of these customized charts, when you get to our 12 grids area here, you can just right click and then go to, hang on just a second, there it goes, right click and then go to maximize sell. And once you do that, then the indicator will actually show up down below. And so you can see how precarious this weekly bearish posture is, and that's why I said be a little cautious going overboard with the idea that, hey, oil is now weekly bearish. And I'm thinking to myself, yeah, right. What it's reflecting is this green line, and really for that matter, the blue and the red as well, are basically looking for recent high points and how much you've fallen from those levels, because the market forecast effectively works like a stochastic, where it's an oscillator and it's trying to look at where is the security in relationship to recent price ranges, and how far away is it from recent highs and how far away is it from recent lows. And so what this is reflecting is the green line has rolled over and is now out of the upper reversal zone. It's at 77 and falling right now. Remember, you can always find that in the labels themselves. And so that once you fall out of the upper reversal zone, then you start off with what's known as a weekly bearish posture. Notice as we go back to the 12 grid view that all of these other pink charts up at the top look a lot different than this pink chart down below. This pink chart down below is light pink. All of these charts up above are dark pink, and there is a reason behind that. The light pink, if we were to go back to the main view here, reflects a situation where the stock has fallen and is now falling between 80 and 50. Once this green line falls beyond 50, and again, we're a long ways away from that. So, I do not anticipate that we'll be looking at USO or oil in general as a strongly bearish candidate anytime soon, unless peace breaks out with Russia and Ukraine, which right now doesn't sound like that's a possibility. But, without some sort of a major type of an event like that, it's going to be a long time before oil has a strongly bearish posture in all likelihood. And it would have to, this green line would have to go from currently 77 to 50 or below. We're so far away from that. In fact, the last time we were in those conditions was back here in December. Some people forget that oil and energy stocks were actually a little bit out of favor going into the end of the year. So it was right here around that last week of December where that green line was able to get up and over 50 to the upside to then have a strongly bullish posture. And had any of us been paying attention to buy oil or oil stocks right here at the end of December, you'd have a big smile on your face today, despite what appears to be a really nasty 2-day pullback here. Because, of course, energy stocks are some of the only ones that are up this year. In fact, the last I heard, and I don't know if this is the case after the last couple of days, but I do know that last week I heard that every single energy stock in the S&P 500 is higher on a year-to-date basis. So had you picked anyone, you could have just thrown a dart at any oil stock in the S&P 500 back here in the final week of December when oil itself was giving you a strongly bullish posture as that green line crossed up and through 50. Any one of the stocks your dart would have landed upon would be making you money at this moment in time in that oil sector. So kind of interesting to think about from that perspective as well. So anyway, point is, yes, it's true. The background color does have to reflect the fact that the green line did fall out of the upper reversal zone, but it's so close to the upper reversal zone where if it would go back in there, and that could happen as soon as tomorrow if oil prices spiked again, you would be right back to a strongly bullish posture. So that's why I wouldn't put too much credibility in this posture change on USO at this moment in time, given the information I have in front of me. Because I look at this chart and say, yes, that is still an uptrend regardless of what the posture is telling me. And it looks quite a bit like what we're seeing with gold, another key commodity. Of course, we had a lot of conversation in Tuesday's video where we looked at the commodities 12 grid, just so I could emphasize how this was not just a gold and oil story. This is a kind of a broader based commodity story, including the agricultural commodities, which I'll actually talk a little bit more about in tonight's trade application example. But gold has not pulled back 2 days in a row the way that oil did. Gold did fall yesterday pretty strongly, but today it actually gathered itself and was up 0.31%. So gold was able to kind of retain their strongly bullish intermediate posture here on the chart with that dark green color. We also see that the US dollar continues to be quite strong. Similar to oil and gold, we saw the dollar fall yesterday, but back up pretty nicely here today. In fact, it was up 0.5% for the dollar, a big global currency like that. 0.5% is actually a decent sized move. 0.5% move on gold or oil really isn't that big of a deal. But for the dollar, it is a pretty decent sized move there. So, that was a nice recovery after a sell-off there yesterday in the US dollar. And then you do see Treasury yields rising yet again. And this has been a pretty aggressive move. Just like this move over here from high to low was pretty aggressive to the downside, we've seen nearly an equal aggressive move back to the upside. And all of a sudden, we're talking about the 10-year Treasury yield above 2% again. That one actually caught me a little bit by surprise while I was delivering my other class earlier today, and it happened to come up when we were comparing dividend stocks to Treasury bonds, and it kind of caught my eye that, wow, I didn't realize that the 10-year Treasury was back above 2% again, because when I did the video with you guys just here 2 days ago, it was well below 2%. So just 2 days, we are back above 2% yields there on the 10-year Treasury. And of course, the flip side of that is bonds sell off. When interest rates go up, all else being equal, bond prices themselves sell off. And look at where we're at here on TLT all of a sudden again, right? We had this reprieve, we had this dead cat bounce that took place over here. Kind of spent a little bit of time around that moving average, and now it's rolling over yet again. And you can see they're not alone in the United States. Foreign bonds are at new multi-month lows. We also see that high yield bonds are at new multi-month lows. That one's kind of interesting because for a while at stretches in 2021, we saw high yield bonds somewhat correspond to the movements in oil, knowing that a lot of corporations that raise junk debt, in other words, high yielding debt, most corporations, of course, want to raise low-yielding debt, right? Because it's more manageable to get through their interest payments. But in this case, high-yield bonds come from sketchy companies, and in the past, those sketchy companies were usually the oil companies. So we saw a period of time last year when oil prices would go up, high-yield bonds tended to outperform other categories of bonds. But we're not really getting that same benefit here all of a sudden. So, who knows? Maybe high-yield bonds, could be an intriguing place to kind of place a speculative bet here sooner rather than later if they are still chocked full of those oil companies. Of course, high-yield bonds tend to struggle in tough economic periods, and I think that's what's weighing on them right now. But if you were to look under the hood of which corporations are raising that high-yield debt, and if there's a bunch of oil companies in there, well, oil companies are being given a lifeline right now. All it takes is $100 barrel of oil to turn your prospects around dramatically. I have a feeling there's going to be immense amounts of dividend increases and stock buybacks announced from those oil companies, in addition to deleveraging their balance sheets as we move forward. So keep your eye on the high yield bond space. Who knows? Maybe there's going to be an opportunity emerging there if we've got a lot of oil companies that feel a little bit better about their prospects moving forward. You will see that we had some further selling in some of the foreign stock areas up above. Foreign developed stocks were down 1.2% today, and foreign emerging market stocks were down 1.8% today. Now remember what I had mentioned to you guys on Tuesday, that I was expecting some sort of a dead cat bounce out of those areas because I had pointed out that we got oversold cluster signals on both of those. And we had a monumental day yesterday in some of those foreign markets. In fact, they were saying that the DAX over in Germany had one of its biggest one-day moves in several years, just yesterday all by itself. So dead cat bounce might have been a little bit of an understatement. That was an epic move for several of those nations. But unfortunately, it just wasn't able to stick. And here we are rolling over to a degree here again just one day later. Now, a lot of Chinese companies, including Alibaba, unfortunately, really took a tumble here today as there's continued concern that tensions are kind of revving up between the United States and Chinese securities, where there may be a wholesale delisting type of an event at some point in the future with the current Chinese stocks that are housed here in the United States as ADRs. So that continues to kind of cause a lot of consternation with investors, and rightfully so, because it's such a binary outcome type of an event, right? Whereas a lot of times you're just wondering, well, can this company's prospects turn around from a business model perspective? We're not really having that conversation right now. A lot of Chinese companies are dirt cheap right now from an operational perspective. The question is whether they will be allowed to continue to be traded in the United States or not. And if that happens, who knows, what goes on after that. We saw it happen to a degree with that ride-sharing company Didi a year or so ago, where they basically removed themselves from the United States markets under pressure from the Chinese market and are now trading their shares over in Hong Kong. So could that theoretically happen with some of the bigger players like Baidu and Alibaba and JD.com and some of those companies? Who knows? We saw a period of time about a year ago where some of the biggest Chinese telecom companies just basically disappeared overnight. Remember that? China Mobile used to be a really big player here in the United States stock market. China Mobile was, I think it was a $100 billion company. And China Unicom and China Telecom, those companies were forced to be removed from the U.S. markets a long time ago, and that could have been perceived as perhaps the first wave. Who knows if we get another big wave after that? So I think that's a big part of this story. Remember, a couple weeks ago, it was Russia that was the concern. Now, all of a sudden, we're adding Chinese concerns to Russian concerns for the EEM, and you can see it's resulting in an above-average sized sell-off of 1.8%. Which was worse than EFA and worse than the S&P 500 here today as well. Let's take a look at the Sector 12 grid now. This will be chart 5C. And these will be the U.S. sectors, and they are the market cap weighted versions. And as you can see, our bullish sectors are kind of clustering up in the lower right-hand corner there. And as I stated on Tuesday, and I've stated multiple times for the last several weeks, it is energy and everybody else. And right now, that should not come as a surprise to any of you that have been listening to this video, because it's been the same thing. It's been broken record type of a thing. And you can see why. If you were just to simply eliminate all those, fancy colors and lines and everything else that we're putting on the charts and just simply look at the price action all by itself, you would say there is one chart that looks good and all of the rest are iffy at best, if not downright ugly. And the one chart that looks good is energy. That's this one right over here to the right hand side, where it's clearly higher highs and higher lows. Everything else is a real crapshoot. Utilities, I guess, would be considered kind of honorable mention right now, because at least they're close to their 3-month highs. Every other chart is closer to its 3-month lows than highs. It does so happen to be the case that real estate also has a strongly bullish posture like these other two do, but you can see it's trading way down below here, a long ways away from where its highs were at the end of last year. So I don't really take that too seriously at this point. However, I would be willing to change my mind under the right conditions. It is possible, who knows, maybe there's an inverted head and shoulders pattern trying to develop down here, with this being a left shoulder, this being a head, and where we're at right now, maybe the formation of a right shoulder. So we'll have to see if that plays out or not. But right now, I think it's too early to kind of jump into that train, whereas the train is already taken off there with energy, and hopefully you've been aboard that train. I know we have been with several of our holdings in our top-down trend trading class, where we have rules that point us to those types of areas. When they start heating up, we want to start paying attention to them. And we were alerted to utilities last week as well when they went up to the number 2 slot on the sector selector. But their charts do not look quite as clean in most cases as what we're seeing out of the oil companies. So it's a little bit of a harder job to find pure trend trades out of that group, but at least they're showing some strength there, whereas most of these other sectors are just pure death right now. I mean, they are ugly. The worst performers here today, no surprise, were the technology stocks once again, given what I showed you on the heat map before. They were down 1.75% today, and no surprise at all. The energy stocks were the best performing sector today. They were up over 3% collectively there, with Exxon and Chevron continuing to just motor higher. Dividend investors' dream with those two, along with the price action here lately. And boy, oh boy, do we need it, because so many other dividend stocks are starting to fall, with the consumer staples rolling over, and industrials and discretionary, and all these other areas really struggling. It's nice to know that it's not just a wholesale sell-off that we've had here. There are patches of green that we've been able to at least look on the bright side with. How long that lasts is anybody's guess, but at least right now there is some bullishness in the marketplace. All right, let's get into our trade application example now. Speaking of some bullishness in the marketplace, I wanted to show you a stock that's catching my eye in the agriculture space. Happened to mention to you guys, I think it was in Tuesday's video, where I mentioned I grew up in South Dakota. I don't live there anymore, haven't for the last couple decades, but I still feel like a South Dakotan at heart. And we are a very much ag-oriented state in South Dakota. A lot of farmers, right? I remember, being on the school bus going from, different football games or basketball games or what have you, and just staring out into the fields of wheat and soybeans and corn. And I've even worked on quite a few farms myself as a hired hand, as a kind of an odd job in high school. So I've even driven a tractor once upon a time. I can't say I drove it all that well, but I did drive it and helped fix fence and doing things with some of the livestock, including castration, that most of you city slickers would probably never dream of and hopefully would never want to. So there's both good and bad for being out in the rural parts of the country. A lot of fresh air out there, I'll give them that. But one stock that I know from my years of growing up in South Dakota is CTVA. Now this is a little bit of a newer stock to the stock market. It used to be part of DuPont, and it was kind of hidden within a mega company as kind of a standalone subsidiary. But this is one of the main seed providers to farmers throughout the United States and elsewhere throughout the globe. I can't remember if they're the ones behind, I think it's Pioneer brand that they do. Either that or DeKalb, one of those two. But, both of those are major players in the seed game for farmers. And you see those signs if you're driving in through, Iowa or Minnesota or Nebraska or South Dakota. You'll see those types of signs out by the fields. It'll say DeKalb or it'll say Pioneer. And, the farmers are very proud of what seeds they're planting to get the highest yields out of their crops, right? And that, of course, is an important undertaking to feed the world. Farmers are becoming more and more important. And one of the things that we've discovered here, especially in the last month or two, is that inflation is starting to pick up not just in the metals and mining and not just in the oil areas, but also in the supermarket. And we're starting to see immense food inflation, right? If you compare how much you might have bought a T-bone steak for in the grocery store right now compared to where it was, let's say, 2 years ago, you might have quite the eye-opening expression on your face. So anyway, we're starting to see, food prices go higher. And remember, in order to feed those cattle and pigs and sheep and everything, a lot of times it's these grains that go into it that are grown by the seeds that come from Cortiva. So it's not just, hey, let's think about bread prices. Remember, in order for those cows to be fed, they need to be fed corn and all this stuff that comes from the main crop. And the world, as it becomes more rich over time and, you start seeing the emerging middle classes, a lot of folks that couldn't really afford to have meat on their table in decades past are now expecting that, the way that we have been accustomed to in Western countries like the United States for decades at this point. A lot of other families across the globe do not have meat on their table every meal, in some cases, the way that we do here in the United States. And so, it's becoming a bigger challenge, in order to feed the world. Because not only do we have to grow crops with in the agricultural world for bread and cereal and all the other things that we eat here, but we need to increase the yields from those crops in order to feed the livestock, in order to help other folks all across the globe get their protein from meat as well. So it's a problem, and it's an area that I think is starting to pick up interest. I've seen a lot of agricultural related names doing quite well here recently. We've obviously bought Archer Daniels Midland plenty of times in my dividend growth investing classes in the past as a dividend aristocrat company in this particular case. ADM and all those grain elevators that they operate, along with other transportation of grains and processing of grains, doing really well right now. One of their competitors is Bunge, ticker symbol BG. also doing quite well. You're starting to see other areas like fertilizers. In fact, we did a bullish trade in this very presentation for you here a month or two ago on CF Industries as just one example. This is a fertilizer company that keeps on motoring higher. Sometimes you're getting some of those equipment companies coming in doing well. So the point is the farm is hot all of a sudden, and it is kind of playing into this chart here with Cortiva as well. And so what I did in today's case was just simply a kind of a blended swing / trend trade. The reason I say that is usually when I'm looking for swing trades, I'm looking for bounces up and off of important support levels. And you can see here, Cortiva was bouncing up and off of the rising 30-day moving average yesterday. But it just so happens that one day after its bounce, it's also breaking out. So it's just kind of a goofy chart where a lot of times you have a much bigger move higher, let's say in this part, and then you have a pullback to the moving average. And then if you can catch it off the bounce, you get a little bit of ways to go until that new high again. But this one was a little bit weird where you kind of went to a new high, and then right here, starting on about February 9th, you just started flatlining at that new high. And then the moving average itself kind of moved up to the price as opposed to price moving down to the moving average. So it's kind of a goofy chart where you're getting the bounce and the breakout in exactly the same spot here. And so this is one where I am doing a one-for-one reward-risk relationship, where I do have my stop loss down here where you see this kind of red bubble and line down here at around, let's call it 48.5. And then my upside price target is up here closer to 58. So what I'm allowing for in this case is for Cortiva to roll over and go below this high from 2 days ago. I'm also allowing it to go below, below the low. So let me rephrase. I'm allowing the stock to go below the low of where it was trading 2 days ago. I'm also allowing it to go below the low of where it was trading back here on February 24th. But if it goes much lower than that, then I'm willing to be stopped out. But what I'm also kind of hoping for with this trade is you'll notice back here, we topped out at around $49 back here on November 15th. You have somewhat of a closer high to that here in kind of the first week of December as well. And then you had another one, it's being blocked a little bit right here, on the first week of January. It was also trading right around $49. So I'm kind of hoping as well in this case that old resistance with that kind of triple top there becomes new support going forward. So that way, if we don't get the buyers to come in right around there or right there, hopefully they'll come in at the highs of some of those prior areas back there. If it breaches those levels, then I've got to be willing to throw in the towel and just say we'll try again some other time. But otherwise, if we are continuing to be in an inflationary environment and we still see money being pumped into the farms in addition to the energy fields and the copper pits of the world and all that other stuff with commodities, and we start seeing the commodity inflation pressures with the eggs as well, then this is one stock that not a lot of people are aware of that could very well benefit. And you can see that this is clearly an uptrending security here. Notice down below on our relative strength lines that we're getting perfect 99 scores with this stock versus the S&P 500, with this stock versus the material sector that it belongs to, and with this stock versus the chemicals industry that it belongs to. So, there's something humming with this particular company right now, and it kind of matches what we're seeing with so many other farm-related plays at this moment in time. So we're kind of playing into that. Okay, so that's what I had for you. Oh, and one other thing I wanted to mention regarding that, over here on our website under the stock selector tool, I did find it within our group, and it's currently ranked 130th out of 1,000 stocks on a relative strength basis. But you can see the color coding change here on the stock rank history area. Remember, this is something that our premium members of Market Scholars can access. Notice that there's a color coding system here for Cortiva, CTVA, right here that I'm kind of circling with my mouse. Back here, you'll notice as recently as October 29th of last year, it was actually in the red. In other words, it had negative relative strength. It then eventually kind of went into this yellow zone for a week and then went into the green, spent a little bit more time there in the yellow, and then as soon as this year has started, so January 7th, it has been green all the way. So this has been a top performing stock on a relative basis, not just here right now with the Russia-Ukraine situation, but it has actually been an outperforming stock since the beginning of the year. So I think that helps our cause with this particular trade here as well. Okay, so that's what I had for you here tonight. I hope you enjoyed the presentation. If you did, I ask one simple request out of you. Click like for me there on Twitter. It only takes you 5 seconds. If you didn't enjoy the presentation and you'd prefer a much slimmer version of only 15 minutes the next time around, then don't click like. And we'll see where we land here when I do the video for you the next time on Tuesday. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.